There we go. Hey, good morning, everybody. It's Hammer. Today is Tuesday, February 6th, 2024. I, of course, with the Originator of Success here at the Daily Rate Lock Conversation, your daily mortgage rate update. The only place on the web where you guys get to be part of the conversation, participate, make sure you comment, say good morning. Let me know that you're here. If you are here live, remember you can join me live each and every day, 9:30 a.m. Eastern Time. If you're here, say good morning. If you're watching on the replay, do me a favor, go ahead and put hashtag replay in the comments. Let me know that you were here. Let Facebook or YouTube know that you were here. If you're watching on Facebook, don't forget to smash that like button, tag an hello friend, share us in a group. If you're watching on YouTube, go ahead and give us a thumbs up. Click that subscribe button. All right, let's go ahead and say hi to some of the live folks who we got here this morning. We got Cindy Pulliam, Mike Morano. Good morning, y'all. Deb Dickinson, great to see you. Ron Siegel, greetings, sir. I hope you are staying safe. I see the tremendous amounts of rain out there. Of course, the ground not really prepared for all of that. So kind of like bonds were not prepared for ridiculous amounts of jobs created on Friday. So Scott Mincer, good morning. Megan Lindbergh, great to see you. Tim Klyla, Sean Segaloff. Sean, haven't seen you in a while. Make sure you get me those dates. My calendar's filling up fast, my friend. All right, so let's go ahead and dive in. Rate sheets this morning should be slightly better than yesterday, right? Finally starting to see some signs of improvement and reversal after getting beaten the last couple of days. Look at this. Oh, I gotta say hi. We got Kai Dumont here this morning. Morning. Pat Tenney, good morning, Pat. So happy to see you. Hope you and your husband are doing well. Nicole Semerad, good morning. Lisa Bollinger, Bobby Searson. Great to see all of you as well. So, all right, let's flip this on. If we take a look here, I'll show you why rate sheets are going to be a little bit better. So right here around 10 a.m. yesterday, this is where mortgage-backed securities, the 5.5 coupon, this is right around where they were when pricing was coming out. You can see it down here. Now, when this line chart goes higher, that's actually good for your rate sheets. When it goes down, that's bad for your rate sheets. And you can see that this morning, here we are up here right now at about 99.44. Just a few minutes ago, we were 99.48. You know, again, just a few basis points, but that's so much better than 99.28, right? Let's say that's about 20 basis points, 15 to 20 basis points better. And that's not going to equate to anything amazing in rates, but it's going to help us improve rates a bit for sure and see some improvement. So an example of that, if we take a look here at Mortgage News Daily, they were showing a rate of 7.04 yesterday. That should put us around 7.02. Maybe back below it where it really should be. But you can see rate sheets really took a jump on Friday. And again, I want to, throw it out there. My advice leading into the jobs data was to float. And it's because, again, anything that I said was risk averse, closing in the next couple of weeks, I said to lock that. I did say that. That kind of slipped through the radar for some people, but if you read the advice, you see it. And we talked about locking anything that was risk averse because you don't know what's going to happen. But I said otherwise, let's give it some time. Now, let's talk a little bit about what changed on Friday and then where's the recovery. And I think we are going to continue to see some recovery. So, but before I get there, let me stay on track here. So reprice risk today is moderate. We want to be careful this afternoon. There's no economic data. We do have a 3-year treasury auction this afternoon. That shouldn't cause any waves, but we've got 3 of the more hawkish Fed members that will be out speaking today. We've got Loretta Mester, we have Neil Kashari, and Susan Collins. And there is a cool little chart here that I will show you that is on, where did it go? Where's that fancy chart? Click on the photos in this graphics. Yeah, no, I don't. Where's the? Bear with me a minute. I see ads, but I don't see the actual chart. Where's the chart? Doves and Hawks. Here we go. When was this one written? Updated January 2024. Okay, cool. So let me throw this on the screen and show you here. We'll pop this on. So if you look at the more dovish, you got like Raphael Bostic, Patrick Harker. Powell tends to be a centrist. He's right there in the middle. Chris Waller, John Williams, Philip Jefferson, Michael Barr, Lisa Cook, Mary Daly. Now, Susan Collins, she tends to be a little bit more of a centrist, but has made a little bit more hawkish comments. But Mester starts to really get to the right, and Kashkari starts to go to the right, and they're more hawkish. And what that means is that they're more likely to say, hey, we don't think that the Fed needs to cut rates anytime soon. They're going to say that they're waiting for more signs of economic, what's the word? Slowdown, if you will. They're looking for signs that continued signs that inflation is improving. So Mester has been known to say just on January 11th here, March is probably too early in my estimation for a rate decline. Kashkari, when activity continues to run this hot, that makes me question if policy is as tight as we assume it currently is. This was back in November. He's actually, I think, made some more recent comments. All of his, Ron, I can give you, this is a cool Reuters here. Ron asked if I could share this, if I could share the URL for the chart of doves and hawks. So I did post it, so it should show up for you. And that is from Reuters. So, but back on the captions here, reprice risk today is moderate. We could see some negative reaction. We're getting a bit of a positive reaction to start the day. Mortgage bonds are up, right at the moment now, 13 basis points. Again, I expected to see. Now, I want to kind of go back in time a little bit here, and let's go to the lock advice. So lock advice is cautiously float. I would still absolutely be floating. Bonds are showing signs of recovery. Right here, this chart, these are mortgage-backed securities. Now, you could see that right after the Fed meeting was on Wednesday, right here, this green candlestick, right? And then we also had on Thursday, it improved, and then it kind of lost ground. Now, going into Friday's jobs data, we expected that we could see some negative reaction, but I didn't expect to see this much negative reaction. However, I said on Friday, we definitely wanted to float. You don't want to lock in on a day like that. Rate sheets are going to get beaten on. And really, we could expect to see some recovery. It wasn't like we weren't down here before. We ended the week before on Friday the 26th, right at those same levels. We actually ended a little lower. It was 99.77, whereas we ended at 99.86. We actually ended the week a little bit better. However, Monday, yesterday, that was the kick in the teeth. I did not expect to see Monday kind of beat us nearly as bad as it did. And this was a bit of a global reaction. A lot of it got blamed on Powell's comments at the 60 Minutes interview. It just seemed a little hard for me they knew his comments. So, but what we have seen and what we want to be very, very aware of is that hopefully the worst is behind us for this round. We saw a 1-2 punch the last couple of days. Friday was ugly, and I knew Friday was going to be ugly, but we've seen plenty of recovery. I could go back to previous days. What was the other labor? Let's see, we had January 5th. So if we look back here, let's find January 5th, right? So, January 5th, we actually look at the movement on that day on January 5th. It closed the day before at 99.86, which is funny because where do we end here? 99.86, right? So it closed the day before on June 4th at 99.86. And then on June 4th. Yeah. And then on June 5th, we actually closed 99.88, and we had a stronger labor market report. So this one, it went all the way down, a low of 99.34, but it recovered on the day. You could see that here in the candlestick. See the way that it's got this long tail, and it came back up. This was the last jobs report. So this jobs report, I knew we were going to get a difference in the way that they make seasonal adjustments on this and the way they adjust the data, but nobody expected it to be quite as ridiculous as it was. But this is an overreaction, and we're going to see markets kind of respond. They want to rally. Traders want a reason to rally. But there's just nothing going on this week that's going to give it to them. We're probably going to have to wait a week from today on the 13th. We get the CPI inflation report. Now, I would float into that report, and that's why my lock advice has been to cautiously float, because I think that that's our best shot at seeing rates start to improve again and seeing an expectation. Now, rates as bad as they are, it's because markets have given up the idea that we're going to have a March rate cut. right? I mean, it is an 85% expectation. I'm rounding a little, but 85% expectation that the Fed is going to leave rates unchanged in March. Now, that March meeting is still not until the 20th. And we could see this actually improve. We could see markets start to price in the idea of a March cut anyway, although I don't think they will. I don't think it'll go crazy. But if we get a strong CPI report on the 13th, we've got another labor report coming in on March 8th. We've got another CPI report coming in that second week of March sometime, should be probably around the 12th. So looking at that, we've got plenty of time between now and that March meeting where rates will come down. And at the March meeting, the Fed is going to have to really, markets are going to be looking for a May cut. And that's really what we're pricing in now. So we're looking at that May cut. This is the killer, though. This is at about 40%, right? So 40% that the Fed would leave rates unchanged in May. I expect that this number will drop back down again. And if we compare where it's been in the past, a month ago, it was a 5% expectation that the Fed would leave rates at 5.25 all the way to May through May. And then a week ago, it was 15%. Yesterday, it was about 40%. And that's where it's kind of capping out now. If this were to continue to get worse, if we were to see less and less expectation of a May cut, that's going to see mortgage rates creep a little higher. I don't think that's going to happen. I think we're going to see markets believing that the Fed has to cut in May because remember, nobody wants to wait. The Fed doesn't want to wait until the data is actually showing the economy slowing down because by then it's too late. What they want are more signs that everything is stable. If the economy does well, but inflation continues to drop, that's going to be a big deal. And we have the inflation report coming out next week, the CPI data, and then they're going to have another one in March. And those are big. So the outlook, hopefully the worst is behind us for this round after a 1-2 punch the last couple of days. I've already talked, I didn't put the bottom third on there, but the Fed rate watch, the March cut is off the table. Nobody's expecting a March cut anymore. And that was all the talk and all the rage. And it drove rates to the bottom on where they were in December, drove them again, as we get kind of the bottom in January. And as we got a pushback and we saw rates disappear, it's because the expectation of a March Fed rate cut disappeared. I don't think this is coming back. We may see a little bit here, but I don't think it'll go below 60%. I really don't. Even if we get some positive reports and stuff, I think that the Fed has put out very, very, very heavy messaging and will continue to do so. And they'll do so for the next month. Remember, they don't actually go into their blackout period until the 9th, March 9th. So we've got a month of Fed members out there speaking. And like today, we've got Susan Collins, Loretta Mester, and Neil Kashkari. So we're going to see that continue to happen. But overall, I think we are in a good place where we're going to continue to see some recovery. I expect to see bonds continue to improve today. At the moment, they're showing up 13 basis points. 10-year Treasury yield back below 4.14. We capped out. Look at where we were back in January. We capped out at 4.18. That was kind of our highlight here. Yesterday, we saw 4.16. So it was still better than that worst level that we saw in January. And I think that we will probably see it now start to drop back down. This 200-day moving average is purple line. I don't really expect that to be too strong of a resistance level. It should have given us more support. I was very surprised to see that we ended at 4.03 on Friday for that 10-year Treasury yield, and that on Monday it had jumped all the way up to 4.16. It's just too high. This is too strong of a reaction. I think markets will continue to improve. I think rates are going to continue to improve. So let's see what you guys are talking about here. Tim said, based on Powell's comments on Sunday, I don't see how March is in play. Yeah, I don't either. But remember, Tim, there are a lot of reports. We need, if we see economic data and labor data show weakness, if that March 8th report were to really, start to come back in play, and we saw revisions to this February report, that'll change the whole narrative. Markets want to see rate cuts, and they think the Fed needs to cut rates. So they're going to be looking for reasons. Ron said, did you really say the Fed doesn't want to wait until it's too late? They always wait until it's too late. They might still think inflation is transitory. Yeah, Ron, I'll tell you, I think the Fed gets too much credit and too much too much blame at the same time for what they do. I mean, they're certainly moving things, but at the end of the day, there's so many moving parts to today's complex economies. I don't think we've given the Fed enough tools. I mean, when you really think about the fact that the Fed funds rate is the rate that banks lend each other money, it doesn't even become relevant to the adjustments on the economy. And yet look at how the implications and how it rolls through. It's pretty crazy. So, but anyway, there you go, my friends. That's it. Again, I have positive hope. I know that I let you all down by not locking ahead of that, but ahead of that Friday data. But I just did not anticipate to see the strong negative reaction. I think it's an overreaction. I think that many of you do too, and I think we're going to see improvement come back on that. So, again, if I've got loans that are closing anytime in February, I am not locking. I am not. That's why yesterday I didn't issue a lock alert. I know that Barry did, and again, this is not I'm not throwing shade. This is just discussion, talking about the differences in how they see things. He issued that lock alert, but I kept telling everybody, lean into this. I think we need to lean into it. I think we're going to see a recovery by the time we get to a week from today, when we get that CPI report. I mean, unless something ridiculous, if we got a negative CPI report, if something showed that inflation was moving up again, that would be bad. But anything else short of that, markets are looking for a reason to rally. So Pat is always my friend. She said, you can't win them all, Hammer. Thank you, sweetie. I appreciate you. Scott said, I think Powell's comments in the 60-minute interview about the deficit are more interesting. Yeah, but that falls on deaf ears, doesn't it? Closest he got to politics on that. Cindy said they actually had a price improvement yesterday. That's good, Cindy. Very, very few lenders did. But that, just to show you all why you might have seen that price improvement. Pricing came out here, and it actually did come, it came up to a little less than where we're at today, yesterday, but very few lenders would reprice better. So Randy said, nice hat. Thank you, sir. Appreciate you. I love my cowboy hats. This is my winter felt hat. So that is what I've got going on there. Crystal said, I'm just happy to have loans to lock. Yeah, right, Crystal. It's good. And this is going to be a good year, y'all. It's not going to be an easy year. Not going to be an easy year. Don't read me wrong, but it's going to be a good year. So, all right. Well, thank you so much. Remember, you can join me live each and every day, 9:30 a.m. Eastern time. Please spread the word. I saw a peak of about 40 people on. I would love to start getting over 100 people on in the mornings to join me. What can I do to make these more interesting for you? What can I do to make these better? Let me know in the comments. Should I change my format? Do I talk too much? Remember, you can also sign up for our written email lock advice, www.ratelockadvice.com. You can sign up for our text alerts at www.ratetextalerts.com. And you can check us out on originatorssuccess.com, because we help you to get loans from Google and social media. We've got review management, review software. We've got automatic email campaigns that go out to your agents, past clients, warm contacts, prospects. We got the weekly rate forecast. We got a lot of great stuff that goes out. Go check us out. And if you'd like a reminder for this show each and every morning, if you'd like a quick text reminder, go ahead and sign up for that at hmmr.io/live-reminder, and I'll send you a text in the morning. Ron Siegel likes my texts in the morning. They wake him up over in California and remind him that he needs to make sure he's got his rowboat ready. So, Ron, I hope your house is not getting pummeled by all this rain. I don't know where you are in California. So, soggy old California. All right, my friends, I'll catch you guys tomorrow, 9:30 a.m. Eastern time. Have a fantastic one. Bye-bye.